Hello and welcome to this week's Questioning the Manager. Today we have Alex Crooke, Fund Manager of the Bankers Investment Trust, an income and growth portfolio investing in major equity markets across the globe. Alex, welcome to Questioning the Manager. Okay, Alex, let's start with the US and the surprise election of Donald Trump. There's been a lot of talk around increased fiscal spending, tax cuts, and the ensuing reflationary play. So what does this mean for bankers?
The key thing for bankers and investing in the US is to think about the economic policies that are likely to flow from the Trump administration. And actually, I think they, on the whole, make eminent sense, actually. Cutting taxes, cutting regulation to try and stimulate growth and infrastructure spending are all probably very good policies for the future. So I think we have to see really essentially the time frame, how quickly some of these policies can get enacted. I think it probably means stronger US dollar over the next year, and it probably also means higher US interest rates as well. So those hand in hand might not be great news to see the stock market continue to hit new highs. So I think we have to sort of look deeper into the portfolio and understand what we own in the US, what might do well in that situation, and actually it may be better value in some of the international companies that have operations onshore in the US, so they would benefit from that stronger dollar.
So judging from some of the rhetoric from leaders across the globe, it seems there's a rise in protectionism. Do you think this could usher in a bear market for emerging markets?
I think this sort of surrounds the question of sort of globalization and whether that trend has sort of peaked, and I think it probably has, to be honest. We've seen over global trade actually since the Great Recession, financial recession 2007, has sort of peaked and is slightly falling. And I think really that makes it tougher for emerging markets to sort of export their way into growth or get the growth from exports. I think there's still plenty of opportunities for emerging markets in commodities, in tourism and other areas like that. But I think you need to look a bit more careful about which countries are likely to stimulate growth from internal mechanisms, internal dynamics, and that to me still sort of focuses my attention back to China, where again the policy is there to inflate and grow consumer spending domestically, and I think that could be very interesting for us as bankers.
Okay, Alex, how about the UK and post-Brexit markets? What has this meant for bankers there?
Again, the UK market seems to be very strong actually post-Brexit. It is a good economy, good levels of employment. Wage growth is okay as well. I think next year, 2017, will herald higher levels of inflation just because of the exchange rate. The fall in the value of sterling will inflate imported goods. But actually, I think you'll see a lot of substitution going on as well. So I think actually the economy is reasonably sound. Again, the dynamics of Brexit will be the interesting opportunity next year, whether we see some results or whether it's 2 years out. But actually, I think the economy is well placed.
Okay, finally, Alex, we've just had a Q3 earnings season. So how have dividends been? And I suppose, what is your outlook for dividend growth?
I think our outlook for dividend growth has moderated as the year has developed. And into next year, again, the exchange rates have played a lot of dynamics in there, and corporate profitability is okay. But actually, dividend growth rates were very strong. They're coming back to their sort of long-term average of 5 or 6% growth. I don't think they'll drop much below that. But next year, again, you should see good growth out of Europe, continuing better trends there. US has been very strong, will be more moderate, I think, next year. And Asia should be, again, a good market for us for dividend growth. We should see strong numbers coming out of that region. So I think moderating, but still reasonably good levels of dividend growth.
Alex Crooke, thank you.
Thank you very much.